Hello, everyone. My name is Braden, and this is OmnisMedia. With all the volatility going on around the market right now, you're probably wondering, is now a good time to sell or a great time to buy? Well, if you ask Jeff Bezos here, he would tell you it is time to batten down the hatches. And if you ask Salman, the head of Wall Street financial giant, he would say it's time for both corporate leaders and investors to understand the risks building up. Now, where does that leave us? That doesn't mean for sure that we will see a really difficult economic scenario, but on the distribution of outcomes, there's a good chance that we have a recession in the United States. So what does that mean? We will have a recession, but not a difficult one. Let's see what that looks like. The three scenarios for the US economy. So there's a positive, baseline, and negative. The positive, we see employment and wage growth slow, no wage price spiral, which would of course be a positive scenario. Wage price spiral was something the Fed was very concerned about for a while at the last meeting, um, because as inflation moves away from goods and into services, that causes a whole nother mess that they would have to fix. Inflation, shelter inflation falls. The Fed said that they don't see shelter inflation peaking until sometime next year. That's why this is the positive scenario. With that being said, home prices have fallen 0.5% month over month. They're still up 8% year over year. But we have seen a 25% decline in home purchases. Of course, lower energy and vehicle prices. We are seeing gas lower and used car and new car prices lower. Energy is a very volatile market right now, and as we'll get to later, energy has a very high chance of going back up and increasing inflation. Under the base case, lower investment slash higher joblessness means recession early 2023. Now, Bloomberg says we have a 100% chance of a recession in the next 12 months, and these people think that we have one too. Core inflation will remain sticky for now, but pricing power rapidly weakens and inventories rise, slowing inflation through 2023. Now, you may be wondering, how do we enter a recession in 2023 as inflation starts to go down? Well, a recession is somewhat of a lagging indicator, and we can see inflation starting to have a downtrend as we enter a recession, technically. And they say that they see a Fed hike or a federal funds rate hike to 4.5% in December, which means November is a 75 basis point hike, and December is a 50 basis point hike. Personally, I do believe that we will see a 75% basis hike in November and December. The negative scenario, housing market in painful correction, is possible. It is possible the Fed doesn't think we will see housing peak until sometime next year. Inflation fails to slow in any meaningful way. It is possible, and especially in higher energy prices and persistent labor shortages. Another bad one would be with a wage price spiral. Yes, as it says here, sticky wage growth, and if all those things happen, we will see rates up to 6%, if not more. And if we look at these charts down here, the negative is very different from base and positive, which is a good thing, which means base and positive are very similar. So we think that there is going to be a more positive outcome over the next year or two. As you see here, it goes up a little bit, down in 2023 as we enter the 100% chance recession, and then skyrockets into 2024. Inflation, we will start seeing a downtick even in the worst case scenario. So imagine if we don't see a downtick, that'd be crazy. But yeah, we should see it starting to hit to the Fed's 2% level that they just love so much in 2024. Now let's look at, so if we see a baseline scenario, global real GDP growth will be at 2.25% compared to the ideal 3%, and an implied downgrade to analyst earnings per share of 11%. Remember, this is the current uh, city's top-down view. This is what they expect. Hard landing, of course, 0% GDP growth, negative 24% earnings per share downgrade. So yes, that would be especially bad for markets. Soft landing, 3%, which is ideal. 0% downgrade to earnings per share. There's a reason it's a soft landing. And yeah, energy prices. This is a big one, especially for Europe. If we see, we don't see much hope, we will say, for energy prices. The baseline is an EU ban on Russian oil, end of US strategic reserve releases, and possible OPEC action limits downside. If we look at this chart right here, the positive one leads us going to crude all the way down to $70, which would be funny. But it does see the base and negative being more correlated, and it actually says that we will see crude start to increase very, very soon, before 2023. And yes, record gas prices in the winter of 2023, 2024. So that will be detrimental to Eurozone. Let's look at the Eurozone really quickly. Of course, positive scenario is stimulus being more than sufficient, and they don't have to actually print more money and deal with inflation at the same time, because that would be very difficult. Inflation hitting its 2% target by the end of 2023, and having deposit rate hikes to 3% by spring. At the moment is 1.25%. Now, base case scenario, economic downturn begins. So that is expected. Inflation averages 12% in the Q4. Last month we had 10.1% year over year, so that would be an increase in inflation until the end of the year, and it adds 150 basis points of extra tightening over the next 3 meetings. Like I said, we're at 1.25 right now, so I'd put us at 2.75, which is pretty solid. Of course, negative scenario, war escalation, energy prices rising, COVID potentially, all that, inflation in double digits through 2023. And yes, that would be unfortunate. Real GDP, in any scenario, they see real GDP falling in the Eurozone. Even the positive, negative, or base, it will fall for a little bit. And they don't expect it to kind of start going up until 2023, when they start to see inflation peak right here at above 12%. So yes, they see inflation starting to peak more, or it hasn't peaked yet, I should say, and then they see a nice downturn as rates go up. So yes, if we look here, they don't. The UK thinks, or they think the UK's interest rates will hit 3.75%. Personally, I think it needs to be a little stricter, anywhere from 4 to 4.25%, honestly. And the US federal funds rate, they think will be at 4.5%. And after we actually learned today, people are pricing in 4.75% and 5% earlier than expected. So that's kind of, yeah. But let's look at China's economy really quickly, because China is a big economic factor. Positive scenario, job market recovers, retail sales improve, infrastructure spending lifts growth. China is actually in a deflation, you could say, in the moment, with inflation only being 0.8%. So it would be ideal if their inflation rose to around 3 to 3.5%. And that would be great. What they expect is going to happen is retail sales and production gradually recover, which is good, which is very positive. And inflation pressures staying muted, reflecting the weak economy, which means that they're not going to see a higher inflation opposite to the US. Um, and it's going to stay muted and have very little growth. Of course, a negative scenario, economy on brink of recession. With frequent lockdowns, they have very frequent lockdowns, but they actually just came out saying that um, tourists might have to have less time in quarantine before they can actually visit, which would be a great start to less frequent lockdowns. And of course, if we look at these charts, we see real GDP kind of growing pretty quickly. Even in the negative scenario, it will start in the start of 2023, but they expect it to start going now. And inflation, they really want to get to 4 to 4.25%, which is very ironic. But yeah, that is a quick rundown of the US, Euro, and China and their economy. And how will that play out in the stock market? Um, who's to say at the moment? I know that I am personally more cautious than I have been before, and I am looking um, at holding more cash and diversifying into safer portfolios. That, of course, can bite me in the butt if we see